Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to the calculation of average AR or accounts receivable collection period. Get ready, it's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you would like to and have access to it, we are in the 328 Average AR or Accounts Receivable Collection Period tab under the Practice Problems section. Closing this back out, we're going to have our information up top, and then we'll kind of shrink down that information so we can more easily see it as we work through our practice problems. So we got the sales top line of the income statement, percentage of sales that are cash sales. So now we're going to say, hey, we got these sales that we're having top line of the income statement, but we got to determine what percentage of those sales are going to be cash sales, meaning we're going to get cash at the point in time that we make the sale, as opposed to credit sales, those which are going to go into accounts receivable, which we will later then have to collect on. Notice when you make the sale, you can think about the cash sales typically being sales that would be made at like the cash register or something like that at a store or something like that. And everything that's going to be a credit sale, one in which you'd have to send out a bill or invoice for those types of sales and then track the receivable. We are concerned with those sales that are credit sales because we want to take a look at how long it takes us to receive the money on those credit sales. The faster we can receive the money, the better, because that's going to improve our cash flow. We'll get the money sooner after we have the sales, and it's more likely that we will be able to collect on the receivables. Statistically, I mean, it's shown that the longer a receivable is going to be staying out or is outstanding, the less likely we're going to be able to collect on it. So for those two reasons, for mainly that we want the cash flow and we want to make sure that we collect on the receivables, we want to be lowering the time of the receivable turnover, getting the receivable money faster. So how can we calculate that? We got the average daily credit sales as one type of calculation we could take a look at. Now in this, we're going to try to break it down to an actual number of days. So how long is a receivable outstanding on average in terms of days? This is a nice number because even without comparison to other industry standards, we still want to compare it to other industry standards, but even without that comparison, we have some idea of what it means. Yeah, we could visualize, we could conceptualize a little bit more easily. Okay, this is how many days it is outstanding. Can we knock that down a bit and take it down to fewer days for the receivable outstanding? So one way we can calculate this, we'll do this a couple different ways. You do want to know the multiple ways of calculating it. You might think, hey, I just know one way of calculating it. That's all I need. But especially if you're going to be working with book problems, you want to understand multiple ways, because a book problem might just give you limited information and force you to calculate it one way or another way. And even if you're doing this in practice, then it's nice to know the relationships between different ratios to be able to just interpret them better. So we have the average credit sales, daily credit sales. So what we're going to do is we're going to take 100% minus the percent of sales that are cash sales, meaning if total sales are 100% of sales, then 20% of them are cash sales. That means that the difference between the 100% and the 20% would be what the credit sales are. So therefore, of the sales made, 80% of the sales are credit sales. We're going to multiply that 80% of the sales 1,200,000 times the 80%, to get that portion of sales which are credit sales, the ones that are going to be on account, the ones where we're not getting the money at the point of sale, but will rather be needing to collect on in the future. They are going into, in other words, accounts receivable. Then we have the average days in a year. So note, when we're thinking about the average days in a year, this is another area where you'll just have to be mindful of, what context it is that you are using this in. You might see this calculated as 365. 365 is the best, pretty close calculation for most years of the number of days in the year. However, you also might see a calculation of 360, and that's one reason you might want to do that is because you're trying to standardize the months so that when you do statistical analysis, you can kind of compare the months on a standard set of days. So instead of having 31, 28 days and 30 days, you can estimate that all months have about 30 days times 12 months, and that would give you your nice 360, which that kind of rounding off is what often people do in, statistical analysis. So then we're going to have our our 960,000 sales on average per day. I'm sorry, that's total credit sales, 960,000 total credit sales divided by the number of days. And that's going to be about 2,666.67 for the average daily sales. Once we have the average daily sales number, we can go to the average collection period, the days outstanding. So the days outstanding could then be the accounts receivable, the 160 divided by the average daily sales to give us the average collection period, or the number of days outstanding, which is going to be the 160,000 divided by the 266.667 about. And that's going to be the 59 about 60 days. So we have rounding. Rounding's always going to be an issue. So we're thinking 60 days. And obviously, the lower the days here, the better, because we would like to have our average collection period be less than that. And this gives us, again, a number that it's more easily conceptualized for most people. So you can say, okay, I would like that number to be going down, see if we can work on collecting faster. Now, the other way you want to be able to calculate this is to think about first the accounts receivable turnover, using that to calculate the collection period, the average collection period, the days outstanding. So the accounts receivable turnover, calculated as the credit sales, same calculation we did up top. We got the total sales. We took the credit portion of them to get to the credit sales, which was 80% of the sales were for credit sales. And then we're going to take that and we're going to divide by the accounts receivable. So if we work that out, it's going to come out even. Is it coming out even? 960,000 divided by 160,000. We have 6 even. So we got the accounts receivable turnover 6. Now this is a useful number, but it means the receivables are turning over so many times in a period, and that's less easy for most people to conceptualize, although it is useful to compare to prior performance and to industry standards and to look at trend analysis. So then we can use this accounts receivable turnover, to calculate the average collection period. You want to know the relationship between this, especially if you're doing book problems, because they oftentimes will give you just this information and force you to do the calculation this way and only this way, right? So we got the days in the year, once again rounding it. So we got the 12 times 30 for 360. You might see 365, depending on the context of the calculation you are using. Then we got the accounts receivable turnover being the 6. So if we take the number of days in the year, the 360 over 6, we're going to get the 60. That's going to be our average collection period. Once again, second format, second way we can calculate it.